Hi everyone. In this video, we're going to take a look at chapter 4, homework problem 4.4. And this will be the last homework problem in chapter 4. As a reminder, just as in the other problems in the video, or in the series of videos here, the information is included in your paper course packet, but I've also copied and pasted some of that into the spreadsheet here, so that we can kind of work in Excel directly and do our work there. So, link things and all that kind of stuff. So, yeah, so without further ado, let's jump in. Let's see, the first thing I want to do actually is make sure I just realize that I didn't, I just pasted this in. So I'm using my auto sum. I'm going to drag this all the way up to the top just to make sure I have my totals in there, right? So, yep. Okay, so all our debits and credits are equivalent. That is shows us that we're in balance, and this is our following adjusted trial balance as of the end of this year, whatever, ending in 1. And we're going to prepare a multi-step income statement in this problem. And I guess let's start. First, we're going to prepare adjusting journal entries that we learned how to do in chapter 3. And then the second part of the problem, we're going to prepare a multi-step income statement, and we're going to include our adjusted balances from part A. And here it tells us the difference between the trial balance amount and actual inventory on hand is due to waste, theft, and clerical error. So some adjustments there. Okay, so we've got a multi-step income statement. We've got a general journal here. We've got an unadjusted trial balance. And in our general journal, we're going to record our adjustments here to begin. Okay, so let's go ahead and just put X1. That always bugs me a little. This is just 2021, for example. We put an X there. You'll see that sometimes because it is the just to make it simple and not identify a specific year. I always just think that looks funny, but regardless, that's just me. So here I'm just putting 20X1 as the year. We could put like 2021 or 2011 or whatever, but I'm just going off of what is included in the packet to make it match. So with that said, let's look at our adjusting entries. So the first one talks about equipment and depreciation. Then we've got supplies on hand, prepaid rent, and physical inventory count. So first one, let's look at depreciation. And like we said, we've got equipment here. So that's the only depreciable item that we have. We have some accumulated depreciation already recorded. And so we're going to come in here and we're going to say this is on December 31st. And we're going to record depreciation expense. And remember, our credit is for depreciation is always going to be accumulated depreciation. And we're going to say equipment in this instance. It's good to identify. That is the account too, as it shows. I guess for the sake of really making this the same, let's just copy this title, paste values, and we'll say to record depreciation expense. And how we're going to record this then is our $100,000, or I'm just going to put to record depreciation expense. Let's do our formulas here. We have $100,000 minus a salvage value of $3,000. So that's our, depreciable base here of $97,000. No adjustments have been made this year, and it's got a 16-year life. So we're just going to divide by the full years in this instance, because there's, like I said, no adjustments that have been made during this year, and it wasn't purchased this year, so we're depreciating a whole year. If it had been purchased, in July, maybe we'd only depreciate half a year, for example, or if it was purchased in 2 months into the year, we would only record 10 months of depreciation because the first 2 months we didn't have it. But in this instance, we had the whole year, this equipment. So we're just recording 1 full year's worth of depreciation expense. Okay, the second part, here I'm going to just copy our entry down. The second journal entry tells us that we have supplies on hand equal to $800. So with our supplies adjustments, we're always going to do supplies expense and then reduce our supplies asset. And so our balance sheet currently shows 5,000, but we go look and we see, oh, there's actually only 800. So $4,200 of supplies have been used up during the year, I think is what we're saying. We did a once a year count, supplies used. Okay, so there's our second journal entry. Our second adjusting entry, I should say. Number 3, the prepaid rent includes 3 months, but only 2 months prepaid remain. So for prepaid expenses, we're gonna move portion of the prepaid rent to rent expense because it's used up. And let's get rid of these. Okay, so it tells us that this number here, 6,000, reflects 3 months. So if we just divide that by 3, $2,000 a month in rent expense. And so this is 3 months, but only 2 months remain. So we can just divide that by 3 to basically, we're crediting by 1/3 by doing that. Total divided by 3 gives us 1/3, and we're reducing this asset here. It's a debit balance, but we're going to credit it by 1/3 to reduce that down to 4,000, and then we'll end up with 4,000 left over to reflect that we've got 2 months left, right? $2,000 per month. 4,000 is 2 of those, so 2 months left, and that's what it tells us here. Okay. We got to update to record rent expense. XP, like I did above. It's fine. Okay, the final adjusting entry, a physical inventory count reveals inventory on hand of $19,000. So now we're going to reduce not our supplies asset, but instead our inventory asset. And it gives me an error. Whenever you see this little green thing, it's an error that Excel is trying to tell you something that looks off, but sometimes that just happens and you can ignore it. That's usually what I do when I'm doing these videos and stuff, if that ever comes up with linking account titles. Okay, so what account do we use as our expense? Not supplies expense, and there's not an inventory expense account necessarily. If you recall from all these problems that we've been doing, the account that we use for expense when it comes to inventory being reduced, usually being sold, is cost of goods sold, right? That's kind of the special account that we use there. So we're going to use that for our reduction in inventory, even though this reduction in inventory is not related to a sale necessarily, but rather to, waste, theft, and clerical error, basically. And we're going to call that inventory shrinkage. Just kind of a term used to reflect these kind of like theft, etc. And the difference here, let's just do our math, is it shows we have 20,000 if we look at our accounting records, but account, like it said, showed that we only actually have 19,000. So we have to reduce our inventory by 1,000 to bring it down to 19,000 to be updated. Cool. Okay, so I'm going to scroll over here a couple, and I'm going to paste in the same information. I'm going to highlight these columns. I'm going to double click, and I'm going to delete out everything. And then I'm going to say, actually, I'm going to move this over just a little bit so that we can clearly delineate these two. And what I want to have this be is that first box there is the unadjusted from our packet and from what we've been working on. But what I want to do is make an adjusted trial balance here. Adjusted, if I can spell right, trial balance. And what we're going to do with our adjusted trial balance is we're going to take our totals and then adjust them for these 4 adjustments, or our ending balances in the unadjusted, and adjust them essentially. So any accounts that we did not adjust, so anything other than these accounts, these are the only adjusted accounts that we're making. Everything else, like cash, we did not adjust cash, so I'm just going to carry that directly over. Accounts receivable, I can just drag this down. We did not adjust accounts receivable, but we did adjust inventory. So we can take our original balance It's a debit balance minus the credit that we did to bring it down to 19,000, and that ends up with the ending adjusted balance. Same thing, similar deal for supplies. So we started with 5,000, but then we counted and said, oh, you know what? Actually, we need to reduce it by $4,200 because there's only $800 left. That's what it tells us down here. Okay. Similar with prepaid rent, we started with 6,000. Well, we credited that debit balance to reduce it by 2,000 and leave 4,000, which represents 2 months. Equipment never changes. Remember, we do depreciation expense not directly as a reduction of the equipment cost, but instead as an increase to accumulated depreciation. So remember, it's a credit balance. It's in the asset section of the balance sheet, but we're going to take that accumulated depreciation and increase it by 63, essentially, for this credit. It's originally a credit balance, so a credit increases that. Accounts payable, we did not adjust. Unearned revenue, we did not adjust. Common stock, we did not adjust. Retained earnings, we didn't adjust. No adjustment to dividends. No adjustment to gain on sales. No adjustment to sales. A lot of these we didn't adjust. Remember, it was just a few items there for entries. So I'm just going to take these all down. Now, we did adjust rent expense. So rent expense unadjusted was 18,000, but we added 2,000 into that. Here's one thing we need to do is we need to add a couple accounts, it looks like, because I can see that we don't have a space to enter some of our adjustments. So I'm just going to highlight these cells here, and then you can click this insert button, and that's just going to kind of push this thing down. Let's check and make sure our summations still pick everything up. Okay, and that's good. So what we want to do is make sure that we have supplies expense and depreciation expense listed, which were not previously in there. So the supplies expense, we're going to debit for 4,200, or we already did, and then depreciation expense is 63. And then the other two, salaries and utilities, were not adjusted, and so then we just end up there with our adjustments. And it looks like we do not balance now, so we're out of balance. So we're going to need to take a look at that. We're off by 1,000, and I think it's probably related to this entry here. Yeah, so maybe we pulled over. Oh, yep, I forgot to adjust cost of goods sold. Sorry. So cost of goods sold, debit balance. We're debiting it for 1,000 to reflect the reduced inventory. We did adjust down the inventory. I didn't pick up that one. So cool. So now we're done with our adjusted trial balance, and that is that. And from here, once we've done all our adjustments, now we can go back and or further, I guess, onward to prepare our multi-step income statement. All right, so now with our multi-step income statement, we're going to come over and say sales. We're just picking all this up directly from our adjusted trial balance. Sales was 160,000. Sales discounts here we'll put in as just a negative number, as that's what shows on your solution manual too, if I put that out for anyone. Sometimes you could put it as a positive, and if it says less, then it comes out just less, but we're just going to do those as negatives and add them together. So net sales, that's sales minus the returns and discounts, etc., is 158,000. And then cost of goods sold, adjusted, right, is the 66,000. So now it's gross profit of $92,000. If we wanted to see what our gross profit margin was, just for the heck of it, we could say 92,000 divided by 160,000, right? That gives us 58%. So just hearkening back to homework problem 4.3, if we were wanting to analyze that. But that gives us over to gross profit. Now let's look at our operating expenses. So we've got rent expense, salaries expense, utilities expense, depreciation expense, and supplies expense. Okay, and then we're just going to add all those together. And that gives us 42,000. So now I'm just going to put that in as a negative again to match the solution guide. So the operating income then is taking our gross profit minus minus our operating expenses. So we have 49. Oh, wait, what am I missing here? Something's missing. Oh, I must have, did I link to the wrong cell? I must have salaries. Yeah, salaries expense should be 35,000. Make sure I got those all right. Okay, there, that looks better. So 18,737. And now in our other gains and losses section, we have gain on sale. So that would be a gain on some kind of sale of equipment or building or land or something like that. Or maybe an investment, something to that effect, but it's not normal operating revenue. That's what, sales revenue would be included above. And then minus our interest expense that we have here. And then that gives us a total other income of $8,000. We don't list any, I guess there's no tax expense noted in here at all. So we're just going to, well, first we'll take our pre-tax net income. It's $26,737. This one lists us to have $0 of tax expense. It doesn't note anything here, so we're going to go with that. And then it would be minus tax expense to get net income. We don't have any, so the answer ends up being $26,737.50 of net income. So we had $160,000 of sales, and after accounting for all of our operating expenses and our cost of goods sold and discounts and allowances and all the other stuff, we have $26,737, about close to $27,000. All right, and that brings us to the end. And so again, what we did, our adjusting journal entries, then we created an adjusted trial balance, and then from that adjusted trial balance, we prepared the multi-step income statement here. So thank you all for following through the series of videos here in Chapter 4, and I will see you all in the next video or in class. Thanks, everyone. Have a good day.